Okay, folks, welcome back. This is our weekend edition of the ICT Mentorship, week ending September 4th, 2020. All right, so here's the economic calendar for this week. As you can see, we are celebrating a bank holiday, Labor Day, in the States on Monday. So it's technically a 3-day weekend here. Canada's celebrating a bank holiday as well. Medium impact Australian dollar. This calendar is showing Aussie, Canadian, Euro, Pound, and dollar-based news drivers, medium impact or high impact. And 9:30 p.m. on Monday, Australian dollar has a medium impact business confidence coming out. And Tuesday, there's an absence of any real market drivers. So that sets the stage for a very uncertain Monday and Tuesday's trading. So it can go either way. And I'm going to present the levels. This is going to be a very short video, but because of the holiday, because of the lack of volume that's really expected until we get around Wednesday, it's a 50-50 shot on Monday and Tuesday, so it can go either way. On Wednesday, we have high impact Canadian dollar bank rate statement and overnight rate at 10 a.m. New York session. And Thursday, 7:45 a.m. high impact refinancing rate and monetary policy statement. So that's going to be the heavy hitter for this week for Euro. 8:30 a.m. ECB press conference and medium impact core PPI and unemployment claims for the dollar. And then crude oil inventory. So there'll be some reaction in the loonie. So Canadian dollar will be moving because of that. And then we have 12:30 p.m. Canadian dollar high impact. We have a speaker, and then 1 p.m. medium impact. The ECB president speaks, and then Friday, Euro group meetings, medium impact CPI for dollar at 8:30 a.m. And that's going to be it. So, long story short, big volatility day will be Thursday for Euro and Wednesday for Canadian dollar. All right, so the dollar index, this is our daily chart, and we traded down into that fair value gap as I mentioned in previous discussions for the last few weeks. We swept it, came back up in. We have a buy side liquidity pool here, and then a fair value gap that could rebalance to 94.35, 94.30. The actual level is 94.33 on this candle's low. So this consolidation, we are still in an area where I favor higher prices on dollar. I still favor that if I had a gun to my head, so that way going into this week, that's what I'm expecting. That might change, obviously, on Monday or Tuesday, depending upon what happens in the marketplace. But nonetheless, I'm still siding on that. We went below these lows, this low here, and then we're kicking it higher. So we may want to reach up into these levels here. That's where my focus is. Now, if we trade down below this area in here, which we'll look at the lower time frames, then we'll probably have to revisit the fair value gap. That means it could touch the 92.22 level, which is the top end or the premium level of that fair value gap on the daily chart. If you don't know what that is, go back and watch the previous recordings, and you'll see what the actual levels are on the daily chart. But these are the actual figures for those lines to be on your chart, and you can trace them back to your obvious fair value gap for the dollar. So let's drop into the hourly chart. So this is our hourly chart. We swept buy side liquidity here. We sent it higher, then it rejected. We do have sell side liquidity below these lows in here. If it drops below that, it would be interesting to see if it gets down into this fair value gap here. So we have somewhat of a buy side imbalance, sell side inefficiency that did respect the consequent encroachment here. So if we lose this, then look for it to trade down to 92.50, 92.45-ish. Okay, the actual levels here for precision, you can see that. We have a buy side liquidity pool residing above these here, relative equal highs. We do have the lower high to the right. That's our signature we look for. So that's a real good likely upside objective should it trade to it. And again, the fair value gap relative to the daily chart, that's these blue lines here. If we trade back up to this old high, it can kick that level and the order block here and then trade down to there. That would be a scenario that could transpire. And again, I'm only giving you things to practice or look at it in hindsight. I am not participating in all on Monday and Tuesday, not trading at all. So that way you know there's no participation on my part, and I don't think it's a high probability. Even though I'm favoring higher dollar, I'm not confident to go in there and trade with the economic calendar that we have. Plus, it's just not imperative that we participate right now. I'm obligated because you're paying me, so we have to get an opinion from me all the time. So I'm looking for it to trade here. How we trade above these levels this week, if at all, will be crucial to see whether or not we dip into the 94s on dollar. 15-minute time frame, you can see again that buy side liquidity pool here. This high being lower than this one, so that's your low resistance liquidity run signature. IPTA will have no problem getting up in there. It does. And it gives up the ghost rather quickly. And so far we're reacting off of the order block right here, this down close candle. We hit that, we're trading up. We have a little bit of a gap here, fair value gap there, and bearish order block and SIBI. So that could rebalance to this candle's low, and that would be enough for it to again sweep above the buy side liquidity pool here, and then maybe come back down and rebalance to 92.80, and it would have to give up 92.80 to dip below the sell side liquidity pool that resides in here. Tricky, I know it could go either way, and as one of the lessons I've taught in recent months, if you can justify a trade on both sides of the marketplace, that is not high probability with my concepts. So you want to be able to determine a directional bias that's bullish or bearish, even though I'm holding a loosely outlined bullish scenario. If I'm proven wrong, obviously, then it goes right back to I'm looking for shorts on dollar and long foreign currency. But as it is right now, in the way the market structure is for dollar, it could literally go sideways. It could stay with a soft bullishness that trades higher and it just refuses to drop lower, or it could just drop lower. So I could look at this chart and the hourly chart and outline both scenarios and consolidation. So if it's like that, if you ever get in front of a chart and you feel like it's just easy for you to make a case for any one of those scenarios, how can you put your charts away and have confidence that you can find the directional bias that's most likely to occur and unfold in the charts, and an entry signal that is trustworthy without being stopped out, and a target? Me personally, I don't feel that is the case right now, because I can justify bullishness, bearishness, and consolidation. So the consolidation factor is that we have the economic calendar up until Wednesday being what it is, and we have a long weekend, bank holidays on Monday. Usually they make a run against the dollar on bank holidays, so that would be like selling off on dollars and foreign currencies allowed to muscle and rally against it. Not all the time, but largely it's been like that in the past, at least in the last 3 decades I've been following it. So if you're looking to practice, it will probably be beneficial if you just stick to the levels I'm showing you here and try not to fancy dance it. But obviously you're going to do what you're going to do, but I hold no concrete opinion or bias as to where it can go to, what entry point, none of that stuff. I'm sticking with the narrative that they may push dollar higher, at least going into this week, and then we'll see whether or not that unfolds and develops. Moving on to euro, it's our daily chart, and we have a sell side liquidity pool resting below here, higher low to the right than this one, so we have a low resistance liquidity run scenario set up there. I don't like all this dipping down like this. Do we need to come back up higher, clean up some of this down close candle, and then rebalance to the order block here, the low of this candle? That remains to be seen. I like the fact that we swept this high here and we gave it up, but just to come down into this order block multiple times like this, to me, it's spending way too much time inside of this down close candle's range. So it just looks as if Personally, I think it should just drop right on into it Sunday into Monday and clear all this out. How we trade through this level, if at all, is important, because if we break below this with any kind of momentum, then they're going to take it into this sell side liquidity pool. Again, same signature, higher low to the right than this one. And then we have the buy side imbalance, sell side inefficiency on this particular candle here. And it's this candle's low and this candle's high. So that candle right there, that would be my near-term objective should we take out these lows and find some strength in the dollar. On the hourly chart, you can see we're still working inside this muddy price range. We went below this low here. I was counseling you all to look at the hourly chart on the community tab, and it traded down into the rejection block here and then reversed right back into the last up close candle. So we are at a point where, given the market structure that's right now in play, if this is bullish, it needs to continue right from Jump Street on Sunday. When it opens, it just needs to keep on going into and trade into that 118.70, 118.80 level to be bullish. If it doesn't do that, if it starts to trade lower, I don't see that as rebalancing any of these price points in here, or trading back down to the last big down close candle as a bullish order block. I don't see that. Even though we have relative equal highs, we have this high being slightly higher than this one. So that, while it is relative in terms of high, this high and this high, it's higher. So I'm looking at that as a real quick rebalance and then drop, and then higher prices on dollar. It's still a crapshoot. It's not high odds. It's not high probability. I'm just sticking with a narrative. And if I'm wrong, then that's fine. But if I'm right, it will convince you, hopefully, with one more piece of evidence, to sticking with a narrative and trying not to juggle back and forth, skipping back to being bullish to bearish to back. You got to stay with one side of the marketplace. And I like, even though we went below this low initially and we recorrected back to this imbalance, we've went back to basically almost 60% of the range here on this up close candle. And now, do we trade lower or do we trade sideways? I don't know. I don't favor a long, but should I be wrong? We have a SIBI here, sell side imbalance, buy side inefficiency, and it could trade not only above here but rebalance up into this level here. But I like the idea that we have a lot of layered liquidity still now below this low that's been trailed up from below over here. So again, there's going to be periods like this, folks, where it's not black and white. It's not going to be binary where it's obviously bullish or it's obviously bearish, and therefore we know where we could enter and where we can take our profits. If you're in doubt, you stay out. It's a very simple process. If it's not clear-cut, heavy one-sidedness to the marketplace where our tools are simply saying it's obviously this, and you cannot justify an opposite view of the marketplace, then it's low probability. If it's low probability, don't arm wrestle it. Don't try to nitpick at it and say, okay, well, I got to see if I can still squeeze something out of this, because you can't relinquish the grip that you hold on your personal opinion. I lost a lot of money doing that stuff. Don't do it. If it's not obvious, if it's not one-sided, if it's not high probability, and that means you can only easily outline it being bullish or bearish, then you have to respect the fact that it's low probability. Unless you just want to gamble, and that's fine. If you want to be a gambler, go in there and learn the lessons the hard way. But it's not required. Okay, you don't need to do that. It's better for you to say, I'm glad I didn't go through all that pain, and I just listened to the good advice. 15-minute time frame on euro. You can see we are still in a range. We cleared the sell side liquidity here. Back up into the range, rebalance to the bearish order block, this last up close candle. Hit that in here. So anything bullish, ideally it should just go right from the opening on Sunday, run the buy side liquidity out, and then expand up with more momentum higher. I don't see it in this chart, but if that's what happens, then that would be underlyingly bullish, and therefore I'd have to revisit the idea of bullishness on dollar. But should we trade down? I don't like this one here. Okay, I don't like that because we had this candle completely trade down to this low, and then we opened up here and then traded back down. So we went back and forth in here. So this really isn't required to rebalance, even with this down close candle. I don't see any necessity there. I think if it comes down to go higher, this one you have to watch because it's towards the bottom end of this candle's low, and to me it just makes more sense to trade there because we had all this back and forth in here. See all these candles back and forth? This is a balanced price range. So it might need to come back down in here and just balance that little portion of price action. We might get some sensitivity there, and they'll defend the 118.10, 118.15 level, and IPTA will maybe make a run for that buy-sell liquidity there at that time. If it breaks below here, then I'm really confident that we're going to lose this low and go after that sell-side liquidity pool or pools that I've outlined on the higher hourly chart and daily. Moving on into cable, this is our daily chart. We have this old high still a factor. I just don't trust this pair. I don't think they're done. I think that they're going to still make an attempt to get about 135, and I'm just being very cautious with this one. And we have the last two down close candles on the daily here. We traded into that last week towards the close of the week and showed some initial willingness to find some support there. But if we lose this, don't think mean threshold, and that's going to be where it's reaching for. It's going to want to go below all that. But look how many candles and how much time we spent back and forth, back and forth. That's a balanced price range. That to me is formidable. That means it's going to take some real bullishness on the dollar to get below this area here on cable. Because remember, even though we go higher in dollar, cable could just stay above or within this range and not want to break lower. It could just refuse to go lower and just deny any kind of bearishness. And it was one of those instances where I got smacked around doing things like that with Swissy, which is why I don't like to trade Swissy. So just know that that could potentially happen. But if we lose the mean threshold of this last down close candle, the big one, not this little one here, if we lose about midpoint of that, then we would probably most likely reach into this imbalance down here, which is very, very, very small, but nonetheless it's there, and would get below all these lows here, and that would form an intermediate term high. So it can get down to here, and then maybe if it trades there, some sort of a bounce up into this area, and we can treat that as a bearish breaker at that time. But right now, hands off of cable. I'm not touching it. All right, here's the 60-minute chart or 1 hour chart. We have a buy-side liquidity pool here. I'd like to see it just run right up into that. But if we are, in fact, seeing significant bullishness on the dollar and cable doesn't run against dollar on Monday and Tuesday, this could see a decline because we rebalance to a fair value gap, bearish order block. And even though we have relative equal highs, I'd like to see it trade above there on either case. If it goes up here and then rejects and goes lower, or trades above it and continues higher, this area here just looks too juicy for it to be left intact. And then we have the fair value gap in the form of a buy side imbalance, sell side inefficiency over here on the 26th. So even though we have this little low, it's lower than this one, this is just consequent encroachment, the respect of the gap from here and here, split that in half. That's what's reacting there. And then we had reaction at the top of the premium level on that fair value gap. See that? There, look at that reaction. So that's why it's important to know these levels, because the IPTA algorithm will go back to that again. It'll remember it. So this is a point of reference over here. So even though we hit it and traded through here and moved away, having these levels on your chart, it's important because you'll know that there's a likelihood, a strong probability that you're going to get a reaction off of that, especially if you have a bias. And while right now our bias is not as clear or definitive, it still supports the evidence that these levels are key. Finally, for cable, 15-minute time frame, you can see buy-side liquidity pool, again, very prominent on this time frame. We do have the imbalance over here. So take that through all this price action. So this and this, extend that through. If we get some bearishness, we could find some sensitivity at 132.40, 3230-ish, and that would be basically defending the 3220 level, and then that might send it higher too. But if we lose all this fair value gap, because we went and offered the buy side here, but offering on a down delivery, that would be a real technical rebalance of this. So that's why I say we don't just see a level, create an imbalance, and then once it fills, we're done with it. Okay, you have to remember it because the algorithm will remember it as well. All right, so that's going to be it for cable, and I just want to briefly mention euro pound. Euro pound, this was the daily low that we could have swept through. We did run the rejection block. I was surprised we didn't get down into it, but it rejected and went higher. We have a bullish breaker here. We've seen some willingness to go higher there. If we go back below it, all of this is no longer there, and it will most likely run below these lows and into that relative equal low in the daily chart, as I mentioned in previous discussions. We had a rebalance to the SIBI here, sell side imbalance, buy side inefficiencies, with buy side liquidity pool here, and then reaction. So again, I can justify a short with all this, and I can justify a long in here, rebalance into a fair value gap. So is that high probability? No. You have to be able to look at the chart and say, clearly, it's bullish and not bearish. Or look at the chart and clearly say it's bearish, not bullish. One-sidedness is the key to finding high probability situations and technical setups. And this can be justified on both sides. And because of that, we elect to say, okay, it's probably going to be consolidation or no trade. So many times, if you go back and look at really, really old videos, back when I was doing stuff on baby pips, where I'd say, okay, it's probably going to go into consolidation. Now you understand what I mean when I say that. It means that if it goes higher, then that's fine. I'm okay with it. If it goes lower, that's fine. But I'm expecting consolidation because it's not a decision to be bullish or bearish. It's just indecisiveness. So it was a way for me to communicate that I'm not going to be taking a trade, and I won't have to justify myself after the fact if there's a price move. That's what I'm showing you here, and now I'm giving you the context as to why. If I can frame a bullish or bearish trade in any given fractal, which is what I'm showing you here, if it's conflicting one way or the other, then I'm not trading. Then treat it like consolidation. But I'm saying to you that it could go either way, and I'm not going to claim to be smart enough to be able to pick which side. But I am communicating that going into this week, I'm still going to hold on to the bias that dollars should go higher and foreign currencies should go lower. That doesn't mean much for this currency pair, because if foreign currencies are dropping against a higher dollar, or they're rallying against a weaker dollar, they're going to move in tandem, that being euro and cable. So in those instances, euro pound will move into consolidation and fail to make any real meaningful swings. And lastly, on the discussion this weekend, we had the E-mini S&P. Now on Wednesday, I mentioned that we were entering a time when seasonality, we should see it drop. We should it start to decline and find its fall low going into the winter. And right on cue, that was the day that created the high, and now we've been trading lower. I have a small little area in here. This is an imbalance, SIBI, sell-side imbalance, buy-side inefficiency, and it does have a buy-side liquidity pool resting above it here. And we have a lower high here. So that could come down, rebalance to this point here, rally back up, hit this level. But if we trade through that and come back in, so in other words, it's got to go through this imbalance and then come back down in, that could be something that's bullish, because we would have a breaker here. So you have low, a lower low, a high in the middle, and the imbalance that would be respected. And then we could go after these relative equal highs and just completely upset the normal mode of seasonal tendencies, because for the last year, stocks have been really doing whatever they want to do, and in seasonal tendencies haven't been all that much of an influence. They've just been going higher. So if we're going to resume bullishness, that's one scenario that could happen. Or if we get up in here and reject this and break that back down and go below this low, then we're in that scenario where we're looking for that October, November low. And post election, then we'll probably see some kind of meaningful rally. If Trump wins, then I think the stock market will explode to the upside. Again, after dropping. It needs to drop down. And there's a lot of people that have made a lot of money in stocks, and they're going to be wanting to take their money and profit off the table because of the uncertainty that's coming along with the election. So there's a lot of things that should lead to this dropping lower. And if things get weird on the tinfoil hat level, it could potentially create, a very steep market crash. That you have to expect something like that, especially in the current climate. I'm not leaving anything out of the discussion as a possibility. Anything can happen. I mean, think about it, folks. They've come out this year and admitted that UFOs exist. So whether you believe in ET or not, the bottom line is this year has given us so many things, and nothing would surprise me at this point. Okay, so just be careful. If you are an equities trader, this is the time of year when you really have to be careful. And then if it starts to decline and we get in there and it's after the election in November and it's still been dropping, depending upon how we have dropped, if we start to see a market structure break to the bullish side, and it's given us an index SMT divergence where the NASDAQ, the Dow, and S&P, one of them will fail to make a lower low. When that occurs, then we'll go in, we'll have a live study where we can start looking at strong stocks, look for undervalued options, and I'll ring in that discussion with using options at that time. But until we get to that point, we won't talk about options. But that's going to be it for this one. Not a whole lot, but just a reminder of respecting the risk, understanding the uncertainty that's in the marketplace at the moment. They're only temporary things, and eventually the market will move around and give us that one-sidedness that we like to work with, and it makes it really, really easy. So you're learning the skill set on knowing what to wait for and what to wait through. Okay, when we're looking for trades that are high probability, you have to understand what makes a market not high probability. So you have to understand low probability settings. If you don't know what those climates are, you're going to be in there trading all the time, expecting high probability, results when it's not likely to give it to you. And you won't blow your account. You won't have excessive drawdown. You won't feel that tug of war of missing out. I feel like I'm going to miss a move. Right now, I'm not worried about missing anything because it can go either way. And I know when the market's favoring one side over the other, and then that's when I'm in there looking to make my kill. I want to hunt then. I don't want to hunt when it's going to be, slim pickings. I want to know that I'm going to take my pound of flesh. And it may not be the very day I'm trading, but it's going to be that day of the week, one of those days. And going into this week, we don't have a whole lot of that probability on our side. Okay, so hopefully that's been meaningful to you and you got something out of this. And it just helps you relax a little bit. So enjoy the longer weekend and try not to expect anything until Wednesday. If I see anything that's lining up for a potential idea for Wednesday in New York session, I'll try to prompt you on the community tab on my YouTube channel. Until then, enjoy your weekend, be safe, and I'll talk to you over the midweek review on Wednesday.